Good morning. I'd like to call to order the June 21st meeting of the Mendocino County Employees Retirement Association. I did have my agenda up here. And our first part of business is a public comment. And if anybody in the audience wants to make a public comment about non-agenda items, this is the time you can do that. I don't see anybody coming forward. There'll be availability of public comment during the items as well. So the next item is roll call and the Pledge of Allegiance. Roll call, please.
Ms. Cubison?
Here.
Mr. Land?
Here.
Mr. Jurdy?
Here.
Ms. Cavness? Ms. Harris? Mr. Shoemaker?
Here.
Mr. Anderson?
Here.
Mr. Cromer and Ms. Smith are absent by prior arrangement.
Great, thank you. And Jim, I'd ask you to lead us in the pledge. Thank you. And this is actually where I call for public comment. And again, seeing nobody come forward, we'll have a swearing in of our new trustee, Alex Land, who is Information Technology Business Applications Manager with the county. And he is an elected general member in the second seat. Welcome, Alex. Judy, you can do the swearing in? Oh, Dan is, okay.
Yes.
Domestic, that I will bear true faith and allegiance to the Constitution of the United States and the Constitution of the State of California, and that I take this obligation freely without any mental reservation or purpose of evasion, and that I will faithfully discharge the duties upon which I am about to enter. I hereby attest that as a member of the Mendocino County Employees Retirement Association Board of Retirement, I will carry out my duties and responsibilities with respect to the Mendocino County Employees Retirement Association in accordance with the highest fiduciary standards and in compliance with the laws, regulations, and policies applicable to the Mendocino County Employees Retirement Association.
I do. Thank you very much, Dan.
You want to say anything before?
Not at this time.
All right, very good. So our next item is our consent calendar, and items can be approved by one action without discussion unless someone wants to pull one. And if anybody wants to pull one, feel free. And so that's approved by consent, by consensus. What was the term we want to use? Unanimous consent approval. Thank you. The next item, discussion of possible action regarding our actuarial experience study, and representatives from Siegel are here, and they're on the screen for us. Welcome, gentlemen. Got a mute up there? Audio?
Just a sec, gentlemen. I think we have an audio problem on our end. We're working on it.
We can try again. How does this sound?
Can you say that again?
Sure. I'll vamp here a little bit. This is Siegel here to present the second hearing of our actual experience study for 2023. Joined with my colleague Andy Young.
Andy, let's see if you can speak.
Sure. And we will be working from a letter that we sent dated June 13th, which has a summary of both our recommended assumptions and a set of alternative assumptions that were requested by the board at the May 17th meeting. There you go. And just to confirm, can you folks hear me okay? Sounds like maybe not. Andy, do you want to try yours to see if it's any better? Andy's going to try his.
Okay. So, Paul, can you turn off your speaker?
Yeah.
And your mic. Can you hear me?
Yes, we can.
So,
Okay. Andy and I, yeah, we can just work from one. We're sitting next to each other in one of your sister systems at the Sacramento County Retirement System. We appreciate your accommodating our willingness to allow us to present remotely. Again, we did a detailed discussion of our report, experience study report at the May 17th, 2023 meeting. And I think the principal recommendation there, if we can scroll down just to the bottom of this page, there's a little table, there we go. Our principal recommendation was consistent with what we are recommending for all of our retirement systems and have been for the last 2 years, lowering the price inflation component of the economic assumptions to 2.5%. There was a graph in our report on page 13 that we do not need to go to right now, but it showed that this is really part of a multi-year, going back really as far as 2010, when the stat assumption was actually at 4%. Since we've been your actuary, we've been bringing that down systematically, and we believe that the 2.5%, well, number one, will give some stability to future reviews of economic assumptions because we think we're going to get there and stay there. We made an analogy to that between that and your mortality assumption, which over several studies, we moved to what's called generational mortality. It used to be that every study we'd be extending the mortality table. We've now reached some stability on the demographic assumptions. And one of the reasons for our recommendation of the 2.5% is to get that corresponding stability on the economic side. We are, of course, asked why are we recommending a lower price inflation in a period of short-term high inflation? And the reason is, this is also shown in our report, that our 2.5% actually anticipates periods of high inflation, including the one that we are in now. If you look at that graph back in the teens, 2014 to 2020 or so, actual inflation, at least the forecast of inflation, that the market-based forecast was around 2%, but we stayed at the higher rate. And so we believe that the 2.5% is a firm recommendation from us. And it both anticipates the Fed's ongoing target rates as well as periods of high inflation like the one that we're in now. There's a lot of other discussion involving the investment return assumption, but when you boil it down, the lower price inflation component simply then moves the nominal return down, leaving the net real return unchanged from its current state. It is currently at 4%. That's the difference between 6.5. That's difference between 6.75 and 2.75. You see the top two lines on the table. So our recommendation, when price inflation goes down to 2.5, all else equal, that pulls the net investment return down to 6.5%. Now, there are some other changes in there. We did recommend leaving the cost of living adjustment, which historically has been set equal to price inflation. We introduced what we call a margin for adverse deviation, which would leave the cost of living adjustment for the legacy tiers at 2.75%. This did involve, because of other changes in the model, a lower confidence level than we have historically seen, but we are comfortable with that, partly because there is some additional capital market assumption optimism, but we'd be very comfortable leaving this for the next 3 years until the next study in 2026. There's cost impacts on later page, but first let's walk through the alternative assumptions. We were requested to do a valuation of a set of assumptions that would leave the price inflation assumption where it is at 2.75 and correspondingly leave the net investment return where it is at 6.75. But then in addition to a little extra conservatism to increase the cost of living assumption to 3.0. So this would still be that same 25 basis point, quarter point margin for adverse deviation. That is a slightly higher COLA assumption compared to the price inflation, but it would instead be on top of the 2.75%, which is a part of the alternative assumptions. So with that, I think we can go to the cost impact, unless there are any questions on the underlying assumptions. Again, we had to do, by the way, the demographic assumptions that are being presented under the alternative are exactly the same as those that we have recommended. The only difference in the alternative assumptions is in the economic assumption. So if we go to the third page of the letter, where it starts with total cost impact, interesting exercise in how different assumptions affect costs. Under the recommended assumption, again, because of the lower expected return, going from 6.75 to 6.5, that's the principal reason to see the increase from economic assumptions of, on the average across all the employer rates, 2.58%. This is not a change though in COLA, because under the recommended assumption, the COLA assumption stays at 2.75. So the economic impact here is really from the low expected return. In contrast to the alternative assumptions, the expected return remains unchanged at 6.75, but the COLA assumption is increased. Now, the COLA assumption, of course, only affects retired members. In this case, only members from the legacy tiers.
That's right. And it would cover not just retirees in the, as reported in the June 30, 2022 valuation, but also future retirees when some of our active legacy members retire. Although the board may remember last time when Paul and I presented the experience study, a comment, a point worth bringing up again is the fact that to the extent that some of our retirees have a COLA bank built up in the valuation, they have already been fully accounted for in the valuation. So in other words, if we have a retiree, let's say with a 4% COLA bank built up, it would take, let's say hypothetically, another 16 years before that retiree can actually get anything over the 3%. And that's what we have already incorporated in our valuation.
Very good. Thank you, Andy. Yeah, and that is something that we want to, that is something we want to keep in mind, that the COLA bank is built into our valuation and it does not have to be reflected separately in the actuarial assumption. So then so basically, because instead of having a change in the expected return, which really affects all your liabilities, active and retired, the alternative assumptions only change the COLA assumption, which affects, again, only the actives and retirees, but only in those legacy tiers. So you can see it's a less cost impact. The demographic assumptions are exactly the same, so it's the same cost impact. Corresponding for the member rates, now this is a weighted average member rate. It's very similar, that the effect of the alternative assumptions is slightly more than half. Slightly more than half of what the effect cost impact would be of the recommended assumptions. We see here the effect on the funded status, increasing the unfunded liability, again, comparable. Here it's a little bit less than half. And then the change in funded percentage. And then finally, we don't necessarily have to turn to it, but also in the letter, we have the cost impact by cost group for all the general tiers, all the safety tiers and the probation tiers, both for the member rates and for the employer rates. And as is almost always the case, the cost impact on the safety tiers, safety and probation, tends to be greater than the cost impact on the general tiers, just because those tiers have a higher liability to payroll ratio. So the same percentage change in the liability will have a greater effect when expressed as a percentage of pay for those tiers. At this point, we can open to questions. Again, we do want to emphasize that, as we said earlier, we want to caution the trustees. We talked about making results aware decisions as opposed to results based decisions. We would caution the trustees that if your principal motive to prefer the alternative assumptions because of the cost impact, in effect, that could just mean that we're simply delaying cost impacts that will happen at some later year. We've also observed, we had a conversation with staff, we observed that if the board were to stay at the 2.75 price inflation, we would be very likely coming back in 3 years with the same. So it's really any cost savings from the alternative assumptions are really just being deferred to a later generation of tax. And with that, as far as the screen, if we can go back to page 1, just to have the various economic assumptions on there just for reference, or defer to the chair if we don't need the letter up anymore. If members have it available, we can just go back to full screen. Mr. Chairman, this concludes our prepared remarks.
So to summarize what I was addressing at the previous meeting, no economists, or I would say very few economists, seem to believe that we will be able to return to the inflationary periods that we just went through. It seems to me that the preponderance of opinion out there about the economy looking forward, not looking in the rearview mirror, but looking forward, is that what we're seeing now is a new era of not necessarily ending internationalism, not necessarily ending offshoring, but maybe looking more at nearshoring and friendshoring of the manufacturing of goods and even services. And so that means that products are no longer going to be made exclusively in the country in which the salaries are the absolute lowest. In the recent era, that was often China and some other countries. But sometimes now they're looking at a balance at both low cost of production and proximity of that production to the end market. So it could be that some manufacturers are looking at plants in the Americas, in Mexico, rather than China, because they want to improve their supply chain capacity here in the United States, delivering the end product to the end users in North America, or same thing with Europe. So what we've benefited from is this international offshoring of manufacturing for several decades. But the trend is maybe not completely reversing, but it's not accelerating and it's decelerating, and it's moving. Manufacturing is moving to places where it's not necessarily always the cheapest. Therefore, we won't have that working against inflation in the United States or in the Western world, and so the most economists that I hear from seem to think that we have now left that period of low, very stable inflation and entered a period of not high inflation, but higher inflation and a more volatile inflationary period because of these disruptions that we've discovered in supply chain issues and other things just in the process of relocating where manufacturing takes place. So I am not seeing where people believe that we're going to see a repeat of the last 10 or 15 or 20 years in products getting continually cheaper, forever always cheaper. I mean, again, the example I give is think about 30, 40 years ago, what was the cost of a color television and how big was that color television? 19 inches? Today, it fills up half a wall and it's probably about the same dollar price regardless of the fact that we have had some inflation. So we've had products working against inflation for decades, and because we've found ways to manufacture them at cheaper and cheaper locations, that is going to slow down, most people believe, and we're not going to see the same inflationary factors. So I think it is possible that in 3 years, or even sooner if the board wanted to, if they wanted to do another study in less than 3 years, maybe in 2 years we might find that somehow we've been able to return to those low inflationary periods, and this recommendation would come back from Siegel. I predict that Siegel actually, in 2 or 3 years, will actually be back at the 2.75, because I think that what we're going to experience is not a return to low inflation, and I think the evidence is going to back that up in the next 2 or 3 years. Again, I'm not saying that the inflation is going to be the 5, 6, 7, 8% we saw in the last couple years, but I don't think we're going to see a return to 2.5% inflation in the next decade.
Mr. Chairman, if I may. 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 Mr. Chairman, if I am I on mute? Okay. Mr. Chairman, may I reply?
Yes, you may.
Okay, thank you, sir. I have to, we have to respectfully disagree with Trustee Jurdy. We have, there are some indicators, for example, we show in our report, there's this, there's a market estimator of long-term inflation, 30-year inflation, which is down at about 2.25% currently. We also have, there's a survey of the various investment consultants, all of whom have economists on their staff. The average of that survey is about 2.4%. While there may be some opinions out there that look at things like the reduction in offshoring, it is certainly not that is certainly not an established opinion that we have come across in the economists that we refer to. And same thing with Siegel's opinion. I will be very, very surprised. It would require probably a change in the Fed's target, something that is clearly established as a forward-looking effect. Before Siegel would be changing its assumption in 3 years. So we're pretty secure with the 2.5%. And we can just respectfully disagree with Trustee Jurdy in terms of the sources that are cited.
Question?
Yes.
Yeah, question to Siegel. If I'm, again, just capsulating it, it looks as if you're recommending to bring down the inflation by the 25 basis points, but that the real rate of return would remain the same. Is that correct?
That's exactly right.
And I'm curious, I know you're doing a number of experience studies with other systems. In those systems, are you seeing I know there are differences in the composition of their asset allocation, but are you seeing a similar recommendation for those systems?
I would say, Andy, check me on this. It's running about 50-50. We're doing quite a number of studies this year. And for some of the studies, some of the systems have actually gone to more aggressive asset allocations since the previous study. And that has served in some situations to offset the lower price inflation, which means they are in fact increasing the real return component. And others, exactly comparable here to Mendocino, because their asset allocations are either the same or more conservative, they have had a situation similar to Mendocino where the real return is unchanged, and so the lower price inflation pulls the nominal return, which is the what we use in the discount rate, and pulls that down. Andy, I'm thinking we're running about 50-50, but it really does depend upon the particular asset allocation. And in terms here at Mendocino, your asset allocation does not support an increase in the real return. And so the nominal return and the inflation component will move down that same 25 point step. That is correct.
Okay. Anyone else? Yeah, I have a question of Dan. Dan, the county currently has a retirement reserve account that they've held on to. How much is in that account?
Shamiz might be able to give you the better answer to that. But let me explain what the strategy that we have for that account at this point. So originally the strategy was fairly broad. At one point we talked about contributing that money to the retirement plan. I actually wanted to do that. That never came forward for a vote of the board by the executive office. And instead the county has held on to it. At this point, our current strategy, and it is a strategy of the board, is to spend that down between now and 2027. I think 2027 is the final year that we make the pension obligation bonds, and to use those dollars to pay the increased pension-related costs that are associated with COLAs between now and 2027.
What's the rate of burn down? What's the total value of that reserve?
My recollection is we already obligated a little over half of it with the 2% COLA we approved this last year. When you spend that, the cost of the pension cost related to that 2% COLA spent down through 2027 was a majority of in other words, we haven't spent it all, but it's been obligated for that 2% COLA we just approved. So we have less than half of that to go for, say,
The next 2 years.
the
3
next
years.
next 3 years of COLAs. So in other words, it won't pay the pension-related costs for all COLAs, but it'll pay a portion of pension-related costs for COLAs through 2027.
So is there a reduction in your non-reserve contribution to the retirement system? So it's just the numbers the county put into the retirement system last year. By using the reserves, are you reducing those numbers out of the general fund or whatever funds you want to call it?
I think there would be, yeah, because we were committing those funds to pay the pension-related cost for the 2% COLA, as I said, which I believe we mapped it out was going to be over half of the reserve.
So in a maintenance of effort situation, you're not maintaining your maintenance of effort out of annual revenues?
Not in this respect, no.
No, okay, so you're reducing your actual contributions out of revenue.
It's an illustration of how tight the county budget is.
I understand it well. Thank you. Any other comments or questions to this? So one of my concerns in this is and it was briefly mentioned in your discussion, Paul, the effects on the UAAL of these different alternatives. Can you go back to that a little bit and talk about that a little bit? And that's making an assumption that everything works as adopted if we adopt one of these. Is that correct?
It is. On page, we don't have to necessarily go back to it. On page 3 of the cost impact letter, it shows what the change in the unfunded liability would be. Now, I have to say here, Chair Shoemaker, and I'm smiling here because we have in our Actuarial 101, we talk about, everybody wants to have the plan better funded. And anytime you adopt more conservative assumptions, it goes in the opposite direction, right? It makes the unfunded go up, makes the funded ratio go down. We like to say no good deed goes unpunished, because if in fact the recommended assumptions are the most appropriate assumptions for the fund, they are our best estimate going forward, well then recalibrating, remeasuring the liability is exactly what you should do. And if that happens to make the plan look a little bit less funded today, then that is actually an appropriate result, just as it would increase contributions. In practice, though, in this case, funded ratios are a metric that everyone talks about. It's not something that we use very much, but there would be an increase. And Andy, I don't know what the actual total unfunded is today. Yeah, there would be an increase of about $18 million in the unfunded liability under the recommended assumptions, an increase of about $6 million, $5.7 million. And that is on top of the current unfunded liability is $250 million.
Yeah, on a market value basis.
On a market value basis, $250 million. And on a smooth basis, it's $234 million. And so I don't want to trivialize this, but we're talking about a change of 18 or 6 on a current base of an unfunded liability of about $250 million, $250 million. So I very much appreciate the focus that your stakeholders will have on the contribution rates, because those hit members' budgets and county budgets immediately. But I would say that the change in the unfunded liability, given the ongoing nature of how we pay off the unfunded, and given the fact that you have a rigorous funding policy, which means this funding policy, this unfunded liability will be paid off systematically. And in fact, part of the reason that the contribution rates go up is to pay either that additional 18 million or the 6 million. So it's in the scale of things, Chair Shoemaker, I think the unfunded liability, it's not one that draws our attention, and we live with these kind of.
Thank you. Okay. Anybody want to take an action here?
Well, I would move to adopt the alternate assumption for our actuarial report.
Do I hear a second? I don't hear a second. Do I hear another motion? Got to take an action, folks. Okay, so you have two choices here. And so to me, I'm going to make some noise for a minute so while somebody decides if they can make a motion. Oh, Jim has his hand up. Thank you.
With the understanding that I can make a motion as the alternate member.
Jim, I'll have to check on that because you can act when either the retiree representative is missing or two of our elected members, and we're only missing one elected member. So I know you can't vote. I do not know if you can make a motion when you cannot vote. I'm going to defer to council on that. Way to put you on the spot, huh, Jeff?
Did you get an opinion from me on this issue?
I did, and I believe it spoke to motions, seconds, and voting, but I'm not certain.
I'd love to see another trustee make a motion. I'm not certain that you can.
Catherine?
I make a motion to go with the recommended assumptions.
Is there a second to that motion?
Second.
Second by Jerry. Further comment to the motion?
Public comment.
But I was going to do that after the further comment of trustees. Not seeing no trustee comment. Jim, I do see trustee comment.
Yeah, I'd just like to add, and it goes back to kind of the fundamental fiduciary duty of hiring the experts that we hire, and in this particular case, our actuaries. And when presented with data or recommendations as a fiduciary, absent, clear reasons to depart from the recommendations they make, that it's really a fiduciary responsibility to accept those recommendations.
Any other comments or questions?
Yeah, I would just like to say I respect Dan's position, Trustee Jurdy's position on this, but in absence of enough context, I would rather go with what the actuarials have recommended, and so.
Okay. And any members of the public have a comment? Do we have people online?
Yes, we do, but there is no public comment at this time.
Okay. Roll.
So I would just note that, that today, the Federal Reserve is sticking with their public position that their long-term target is 2% inflation. And the commentary out there is at some point they will have to abandon the 2% and pick a higher number. Not that they'll be picking a number anywhere near 5 or 6%, but it might be more like 3% inflation as the target. And what I predict is that when they do abandon the 2% inflationary long-term target, the source that that Siegel cited of the consensus number they're showing is also going to go up at that point.
Okay. Roll call vote, please.
Mr. Land?
Aye.
Mr. Jurdy?
No.
Ms. Cavness?
Aye.
Ms. Harris?
Aye.
Mr. Shoemaker?
Aye.
Ms. Cubison? Aye. Approved.
Thank you for coming back and talking to us about this. And Dan, thank you for your deep look into this item and bringing it to us further for discussion. With that,
Mr. Chairman, Siegel will be leaving the meeting. Thank you very much again for allowing us to participate by remote.
thank you very much.
Thank
Okay,
you,
bye-bye.
Andy. Thank you, Paul.
Have a good day.
Okay, that brings us to item 4, which is an educational presentation from PIMCO, Total Return Strategy Review.
Good morning, trustees. We've got 2 members of PIMCO here this morning with us. Matt Clark, Senior Vice President and Account Manager. He's in the room here. And Justin Barnum is online, a Vice President and Multi-Sector Fixed Income Strategist. We're going to do a little swap here of locations, and they're going to get started. Thanks for being here, guys.
Great, thank you for doing that. I always get in trouble for writing on the screen. Sir.
Justin, were you planning on sharing your screen?
I think Matt Clark, my colleague, is going to stop the presentation, but not mistaken.
I'm all set to do that for you, so just to let you know.
So, Matt Clark, are you available?
Could I ask one favor of you as you present? Some of us do use the hard copy in front of us and don't do the screen, so if you could state the page you're working off at any time that you might go out of order or whatever, that'd be great.
Certainly. I just want to confirm that everyone can hear me okay in terms of the audio quality.
You might need to speak up just a little bit for us.
Sure. Are you able to hear me okay with the audio quality?
Down.
I think so.
Yeah, we can hear you, Justin, and apologize, I was just working on the technology myself, so I think we're all set on our side. Okay. Well, good morning, everyone. As Robert mentioned, my name is Matt Clark. It's a great pleasure to be here today, so thank you very much for taking time out of your day and your schedule to visit with us. Just by way of background, I've been at PIMCO for a little bit over 20 years. I previously was in the U.S. Army for 8 years before joining PIMCO. So really pretty straightforward career trajectory. In my current focus, and really for the last, I don't know how many years, 10, 11, 12 years, I've exclusively worked with public sector retirement plans. And I have the very good fortune of working with many of your colleagues in California. So, you know, the folks down the street in Sonoma I get to work with, as well as many of the folks in the Central Valley. So it's great to visit with you all, and excited to provide a real brief introduction regarding fixed income fundamentals. And then I'll hand it over to my colleague, Justin Barnum, who will talk a little bit more in depth about your investment in the Total Return Fund. Just to introduce Justin a little bit more, I've had the good fortune of working with him for 16 years. He's been a great resource for us and has deep expertise and knowledge in our multi-sector bond strategies, of which Total Return is one of those strategies. Before I get going any further, though, let me just say thank you again on behalf of all of us at PIMCO for the long-standing relationship. We understand that we are responsible for just under $75 million of your participants' assets, and we understand that those assets are directly tied to paying the grocery bills, the electricity bills, and all the things that you need to fund when you move into retirement after a really satisfying career in public service. So I want to emphasize how important it is to us to maintain the relationship with you, how thankful we are for the business, and how seriously we treat the responsibility to manage these assets in a prudent and a responsible fashion. If we go to the agenda page, our plan for this morning is to spend roughly 20 minutes on fixed income fundamentals, and then move the discussion to a review of your investment in the Total Return Fund for about 20 minutes. We've incorporated about 10 minutes of question and answer time into both of those sections. So that would be roughly an hour, but we're happy to be more long-winded, which is what you typically, I think, would ask. So if you want us to stay here for 2 or 3 hours, we're delighted to do that. But on the off chance you need us to be more concise, we can also tailor this to be more concise and more targeted. So Mr. Chair, I'll just ask you for your guidance. One, does that plan work? And do you need us to sort of adjust our timing in any way? And if there's any sort of topics that are top of mind, would love to hear those up front so that we can make sure that we address them in the discussion.
I think that we probably control the time frame as much as you do with our questions or comments. So you can proceed, and if I'm not uncomfortable saying, oh, I think we're getting a little long here, so go
Fair
right
enough.
ahead
Okay.
with your plan.
Okay. And are there any topics for the board that are sort of top of mind that you want to make sure that we address as we go through the conversation?
Well, so the question, this is a bond portfolio,
Yes.
not a stock portfolio.
That's
but,
right.
But I'll still ask the same question that I think it needs to be central to our question for all of our stock portfolios, which is, why is your fund both earning higher than, let's say, average for your type of sector in terms of returns, but also why is your fund experiencing, do you project it will experience reduced volatility compared to other funds? So even though bonds are less volatile than stocks, they also have lower returns than stocks.
Right.
So as you compare yourself to other bond funds, like your bond fund, why is your bond fund, do you expect to have higher returns and less volatility than other bond funds? Because ultimately, one of the reasons we have bonds instead of all stocks
Right.
is because we're trying to have a ballast against the volatility of our stocks. I've been trying to make the case that we need to look closely at our stock portfolio to identify mutual funds that have both characteristics of high yield but also less volatility, so that we're not more dependent, let's say. I'm not saying take
Yeah.
money out of bonds, but so we're not being pulled into taking even more money out of stocks and putting into bonds.
I think that is a terrific question because, as you highlighted, a key role of your bond allocation, and where half of that is to diversify from other risk exposures in your broader portfolio. Justin will actually talk about that in detail in terms of how our strategy really does well in providing that risk diversification, so that investing in a bond fund, you don't end up just picking up more equity market, more volatility returns, which can be the case with some other bond strategies. So we'll, a little bit later in the presentation, we'll spend some time talking about the diversification benefits of this particular strategy. But I think it's a great framework to analyze the investment from. Okay. Why don't we jump right in with the educational component? Let's see here. Okay, and so we are on. Bear with me as I sort of navigate here through the technology. And on the page, thank you. We're on page 5. So I just wanted to provide a little bit of context regarding the fixed income markets in general. As you all probably appreciate, the stock market sort of vacuums up the vast majority of the financial press attention. But interestingly enough, the global bond market is in fact larger than the global stock market. So this is through June of last year. The global bond market was just under $130 trillion in size. Not that much bigger than the global stock market, but to put that in additional context, the U.S. economy is about $30 trillion in terms of the goods and services we produce each year. So you can see that the global bond market is very large, very liquid, and from our perspective, this is great because we have built the resources over the 50-plus years that PIMCO has been around to invest in the full range of fixed income securities. Now, if we go to page 6, just to give you a snapshot of how that how those assets are distributed regionally, the large majority of the global bond market, or the plurality, I guess, not majority, is in the United States. But there's other areas of fixed income investment that are noteworthy. Certainly Europe, Japan, and China are all areas that we've seen remarkable growth in terms of fixed income assets over the years. But again, the U.S. is the largest and deepest of the capital markets, and that's true for the fixed income markets as well. And of course, that's the focus for your investment here, is in the U.S. market.
I'll ask, where is Taiwan in this pie?
You know, it would be so small that it wouldn't make it into kind of even the colors.
Thank you.
Yeah, other developed. Now, the way we kind of capture the broad attributes of a market is with a benchmark. So on the stock side, a common benchmark is the S&P 500. On the fixed income side, a common benchmark is the Barclays Aggregate. That is, in fact, what you all are benchmarked against in terms of evaluating your performance. And it just really is a snapshot of the different securities that are captured in a given market area. So the Barclays Aggregate has a duration or interest rate sensitivity of about 6.2, and right now it has a yield associated with it that's in the neighborhood of just over 4%. And we'll go into a little bit more details about those attributes momentarily. Importantly, the Barclays Aggregate is composed of 3 primary sectors: treasuries, which is debt issued by the federal government; mortgages, which are mortgages that you and I likely own ourselves or pay on ourselves; And then credit, this is the type of securities that are issued by corporations to fund their operations or to new build plant and equipment and things of that nature. Okay, so I've been talking a lot about bonds. I haven't really defined it. A bond is nothing more than a loan. And if you turn to page 7, page 8, we lay out a typical set of cash flows associated with that loan. And so in a bond, an investor gives up an amount of principal at the very beginning. That's that large blue line pointing down. And in exchange receives a series of coupon payments, and then if all goes well, the principal payment at the maturity of the bond. And the key question is, for an investor, what should you pay today to receive those series of cash flows out in the future? And the price today for a bond with a given set of cash flows is nothing more than, and again, forgive the use of the formulas here, but on page 9, it's the present value of all the cash flows associated with the instrument. So all the present value of all the coupon payments and the present value of the maturity payment at the end of the bond. Well, how do you get the present value of anything? You divide it, the stated value by the market rate of interest prevailing at the time that you're making the evaluation. So that's that Y number in the bottom. And this gets to, on page 10, the intuition behind this unusual, or I would say non-intuitive relationship between yields and bond prices. As yields fall, you're dividing those future cash flows by a smaller number, so the present value goes up. And as yields increase, you're dividing those cash flows in the future by a larger number, and so those prices come down. So that really sort of non-intuitive attribute of the bond market, as yields fall, prices go up, and as yields rise, prices go down, that's captured in just from the math of the way you value these instruments. And it's very straightforward. And truthfully, it's true for all financial instruments. You know, as yields go up, in theory, the cash flows that you get in the future are going to be worth less, and so the price of that instrument today should come down. That is part and parcel what happened in 2022. We had a noteworthy increase in interest rates for a lot of the dynamics that you all have been discussing this morning, the sharp rise in inflation and the Fed trying to get ahead of that. Well, that caused bond prices to fall as those market yields went up. It also had an adverse effect on the stock market, of course. Now, it's a bit unusual to have a year like 2022 where both the stock markets and the bond markets are down, but it really, I think, highlights the importance of market yields in terms of driving sort of these longer-term price effects. Okay, so we've talked about price dynamics, the yield and price relationship. But what would be really nice would be to have a single measure that can give you an estimate of, well, how sensitive is my bond that I bought today to changes in interest rates? I want to know if interest rates go up by 1% or down by 1%, what will be the change in price of my bond? And that's where the concept of duration comes in. So duration measures the price sensitivity of a bond or a portfolio of bonds to changes in interest rates. And it's influenced by a variety of factors, but really I think the key takeaway is in the bottom right corner of this page, on page 11. If you have a bond that has a duration of, say, 3.63 years, and it starts out with a price of 100, if interest rates go up by 1%, I'm going to expect my bonds to fall by some amount. Well, how much will they fall? Well, they'll fall by the amount of the interest rate increase times the duration. So we take that 1% interest rate increase, we multiply it by the duration, and we would expect a price depreciation of 3.63%. In other words, I had a bond that at the beginning of the year was priced at 100, interest rates went up by 1. At the end of the year, I would expect the price of my bond to be around $96 and a little bit more, roughly. And we're making some simplifying assumptions, but that math is pretty helpful in terms of assessing whether or not you have a lot of interest rate sensitivity. Now, you can imagine this example. If the duration of this bond was, say, 15 years, and interest rates went up by 1%, you would see a price decline of 15%. So its duration becomes a really handy way of asking yourself, how much interest rate risk does this bond or this portfolio have? Lower levels of duration mean less interest rate exposure, and higher levels of duration mean more interest rate exposure. One last note on duration on page 12. Duration is really great for assessing the impact of interest rate movements when those interest rate movements are relatively modest in nature. But as interest rate movements become more extreme, duration begins to break down as an estimate. And that's because the relationship that duration assumes on the next page, on page 13, duration assumes a linear relationship between prices and yields. In fact, the relationship is convex. Another way of saying that is as yields fall, the price of bonds go up, and as they fall, they go up at an accelerating rate. So duration doesn't quite capture that acceleration in prices, and so we use other measures to sort of adjust for that interest rate sensitivity. And we'll talk a little bit why this is important. In one sector in particular of the bond market that's very large is the mortgage-backed security sector. That's a sector that's very liquid, very high quality, but it also doesn't exhibit this sort of positive effect of as yields fall, the prices of the bonds go up at an accelerating rate. Okay, last couple thoughts here, just to keep us on time.
We have a question.
Oh, yes.
Tim?
Matt, thank you. And just looking at the, the types of bonds that are out there and the impact on the market value of the bonds, I'll date myself. I'm thinking back to a time where there was a lot of corporate debt that was issued.
Yeah.
You had some higher coupon rates, and they were held for longer durations, in part because of the interest rate that was paid. Essentially,
Yep.
the bond was for two reasons. One was for the market value of it and the stabilization as far as your risk. But there was also it was a significant income stream.
Yes.
Is that kind of old school bond thinking? Is that gone?
No, I mean, perhaps even the best place to start was, well, why would you own bonds to start with? You own them first for the income, usually. So bonds are described as fixed income. There's a contractual guarantee from the folks that have issued the bond to the person or persons that have bought the bonds that they're going to receive a set amount of coupon payments and income over time. Bonds also have these other really attractive features such as diversification and liquidity preservation, all those sorts of things. But income is a key objective. Now, the fact is that it's been a tough environment for bond investors over the last, really you can go back prior to the global financial crisis, because really since the fallout from the tech boom in the early 2000s, central banks worldwide have been very aggressive in trying to support global economic growth, and they've done that primarily by lowering interest rates to make it easier for folks to borrow, and then by borrowing to be able to go out and spend, whether it's individuals or organizations. And so we've come through a period where interest rates have been, in a sense, artificially maneuvered lower, and we're coming out of that period as evidenced by what happened last year. So it's a long answer to your question, Jim, but investing in the bond market for income is very, very much front and center for investors, and I think many plans right now, in large measure because with return targets, in the neighborhood of 6.5% to 7.5%, depending on the plan that you're working with, you can get close to those return targets with the anticipated income or yield from high-quality bond portfolios. And that's actually, we think, a great thing. It may allow investors to get to their longer-term return targets without having to take maybe as much risk as they had in the past. Because in the past, you couldn't get those sorts of income and returns from the bond markets, largely because of what was happening from the policy environment to support economic growth.
Anybody else while we got? Okay, thank you.
Just a few last thoughts. I've referred to one market rate of interest. The truth is that interest rates vary by the length of time that you're lending your money. So you would expect in a normal environment that if you lend your money for, say, 2 years, you would get a lower rate of return or lower income than you would say if you lent it for 10 years or 30 years. This is on page 14. In fact, in the environment that we're in right now is a bit unusual, where short-term interest rates are higher than longer-term interest rates. But my point in this is that there are really multiple interest rates depending on the tenor at which you want to invest at. And to account for those dynamics, we not only use duration in managing a portfolio, but we mix the maturities within the portfolio so we capture the different rates of interest that are on offer across the marketplace. You know, in the interest of time, what I'll do is touch on the other, I guess, three last kind of key concepts. One of the most important things that I hope you take away from this educational portion is on page 16. So I've talked a lot about price changes, right? And we've talked about duration as being a measure of price sensitivity of a portfolio of bonds or a bond. But bonds are a bit different from other securities in that the total return of holding a bond is really a combination of not just price changes, but also the income you get from your investment. And so this is true for really any capital market asset. Total return is the price change plus the income you get. Now in the stock market, that green box of price change, that really drives the total return of stocks because the income component of stocks in this environment is quite low. Think of the dividend yield being, you know, somewhere around 2-ish%. For bonds, what drives their return over a longer term basis really is the income that they start with. So the yield to maturity of your bond portfolio is the best forward-looking predictor of what you should expect to get from bonds over the life of your investment. And right now, the broad bond market, which had been yielding about 2%, the broad bond market now is yielding over 4%, as evidenced by the Barclays aggregate. And that's the best forward-looking estimate of what you should expect return. So there's a lot of sort of ups and downs in prices with bonds day in, day out, but really what drives the return of portfolio bonds is the yield that it starts with. And we're starting with really attractive yields right now, much more attractive than in the 20 years that I've been at PIMCO. Two last sort of quick thoughts for you. In the discussion of interest rate sensitivity, that really applies to the government sector, the treasury sector. As I alluded to, there's two other sectors of the bond market, that being the credit or corporate sector and the mortgage-backed securities sector. In the credit or corporate sector, one of the primary risks you're taking on is when you lend money to an organization, the question is, will they give you that money back at maturity? Now, you don't have to really worry about that with the Treasury, in theory, because the Treasury can always just print more dollars to hand back to its bondholders when the bill comes due. But corporations and private entities and other public entities don't have that luxury. So when you invest in that sector, your primary risk that you're taking on is what we call credit risk, the risk that someone won't make good on the agreement they've made to pay you back. The other big risk that we think about in terms of generating returns within the bond market is this concept of reinvestment risk. Now, that's something that we all participate in as homeowners. So after treasuries, the largest segment of the bond market is the agency guaranteed mortgage segment. And with mortgages, what happens is that, you know, we as homeowners, we go to buy a house, we take out a mortgage. And if our mortgage conforms to certain requirements set out by the agencies, Fannie Mae, Freddie Mac, Ginnie Mae, those quasi-government agencies will guarantee the timely principal and interest payment of those mortgages to the investor. So I take out the mortgage, it gets put into a big pool of other mortgages that's guaranteed by one of these government agencies, and then it's issued in the capital markets for folks like PIMCO to buy on your behalf. And so when I write my mortgage check and send it in, most of that money gets passed through to the bondholder at the very end of the line. Now, in that environment, I, as the investor on your behalf, I am certain, or fairly certain, that if anything goes wrong, Fannie Mae or Freddie Mac is going to step in and make good on those payments. I don't have to worry that Matt Clark is going to default on the mortgage, because if he does, these agencies step in and they make good on those payments. But what I have to worry about is whether Matt is going to pay me back sooner or later, right? So I know that for the most part, when folks take out a mortgage, they're on average going to hold it between 7 and 10 years because folks, you know, they change housing. They might have to change because of a job or their family situation might change. But for one reason or another, they may have to pay off their mortgage earlier than, say, the typical 30-year fixed period that most of us sign up for. In environments like we're in right now, when interest rates have gone up quite a bit, what you'll see happen is mortgage borrowers will hold on to their mortgages that have been originated at low rates for as absolutely long as they can. So I'm expecting to get my money back after 7 years. In fact, Matt may not pay off his mortgage for another 15 years. And then conversely, when interest rates drop, and I've got this mortgage that I bought from Matt that's really attractive, say it's paying 5%, what's Matt likely to do? Well, he'll try and run to the bank and refinance his mortgage and give you all that money back at exactly the point in time when you really don't want to have it back because interest rates have come down. So that reinvestment risk is really part and parcel to what it means to invest in agency guaranteed mortgage-backed securities. Again, there's really no question that you're going to get paid. It's a question of when exactly you're going to get paid. And the reason this is so important is because, as Justin will highlight, this is an area that we think is really, really attractive to invest in right now because these bonds are very high quality. They're easy to buy and sell. In other words, they're very liquid. They offer a nice rate of return for bearing that reinvestment risk without having to put your money at, say, default risk by lending to corporations. Okay.
So would you say that the primary risk then is that interest rates will be going down and therefore people would start cashing in or selling off? So you're saying it's a good risk because the bet is that interest rates are not going to be falling anytime soon.
Yeah, the primary risk really with mortgages isn't so much that interest rates will go down or up, it's that they will move around a lot. It's when there's lots of interest rate volatility in the marketplace that these mortgages get very difficult for folks to price, because if interest rates go up a lot, then folks hold on to the mortgages, and if they come down a lot, they pay them back. Either one of those scenarios is tough for the person who's bought the mortgage bond. Because we had such significant interest rate volatility last year, these bonds were pushed down in price significantly, and they became much more attractive to own. Now, all things being equal, our base case is that we will experience a bit of a slowdown as we work through the end of this year and into next year, a relatively mild to moderate recession. That would imply lower interest rates. And so we would expect that to impact these bonds. But that dynamic is already reflected in the price of these bonds and more. So even that happening, even if interest rates come down and people begin to prepay their mortgages, we're being compensated more than enough to overcome that effect in terms of generating a good total return. On top of that, if we were to compare them to, say, a different area of the market like corporate securities, if the economy does slow and revenues for corporations fall, we would expect the price of those bonds to go down more because they'll be under more stress. So on a relative basis, we think that segment is more attractive than other segments of the market.
So with the fund that we are invested in with
Yep.
PIMCO, what's the percentage? I mean, you're kind of extolling the virtues at the moment
Yeah.
of this aspect of the bond market.
Yep.
What percentage of our fund is in that portfolio or that genre of bonds versus the corporate bonds you just said right now may not be the most desirable at the moment?
Yeah, I think that's a perfect opportunity for Justin to jump in, but we can point you to sort of the specific exposures. Before we do that, any questions? So this kind of, I think, is a good way to wrap up the fixed income fundamentals portion of our discussion. Any other questions about the topics that we covered in terms of interest rate dynamics or credit or reinvestment risk?
I don't see any.
Okay. So why don't we start with talking about the mortgage-backed security exposure in the portfolio. So Justin, maybe I'll bring you on and make sure we can hear you.
That sounds great. Just testing to make sure that you can hear me okay.
You're coming in a little bit garbled.
Apologies, but is this any better if I get closer to the microphone?
It is better if you're closer.
Just a sec. I'm sorry.
Hold on, Justin.
Ryan, can you try turning up the microphone for the person speaking off our Zoom so we can hear them better? I'm sorry. Go ahead, Justin.
Certainly. So to answer the question directly about the allocation to agency mortgage-backed securities and total return funds, as of the end of May of this year, the allocation to the agency segment of the market was about 40%, relative to about 28% for the portfolio benchmark, Bloomberg U.S. Aggregate Index. So as Matt had noted, this is an area of the market that we have been highly convicted on, given the fact that valuation.
We can't, we're not, some of us aren't getting the,
Sure.
it's just a little garbled.
Is this any better if I?
Yeah, that'd be great. Have him call in.
So Justin, would you mind calling in via phone instead of talking to us through the computer? But while he's doing that, what I'll do is I'll turn you to, let's see, yes. So the relevant page in the presentation is page 44. And this gives you a sense of the primary positions in the portfolio. So on page 44, at the very top, you'll see the duration positioning of the portfolio relative to the market. We're basically running a little bit less interest rate sensitivity than the broader market, so 5.6 years versus 6.3 years. But specific to the agency MBS question, Justin highlighted that on a market value basis, we have about 40% of the fund invested in agency guaranteed mortgages versus 28% that you could get if you were just passively investing in the benchmark. And why are we doing that? Because we feel that this is a sector of the market that's very high quality in terms of its credit orientation. These instruments are very liquid, and they offer a better yield than what we would get, say, were we to invest in just treasury securities. Sure.
I'm sorry, could you slow down just a little bit? So I'm following on page 44, where we look at the top chart. It shows benchmark 6.3 years for the term of the duration,
right,
and 5.6% for this portfolio that we are invested in with
yes.
PIMCO. Now, below that, I see sector exposure. I see some color codes, but I'm not following what are the color codes referencing.
Thank you for letting me clarify. The gold bars are the exposures of the benchmark. So if you were a passive investor, this is what your portfolio would look like, the gold bars. As you can see, this is weighted on duration contribution. So to decompose that sector exposure, within the benchmark, if you look at the gold bars, most of the benchmark's interest rate exposure is coming from treasury securities, less is coming from investment grade securities, and then there's the final component is agency guaranteed mortgages, all in those gold bars.
Just again, slow down. So investor grade securities would be corporate bonds?
Yes.
Okay. And agency mortgage, those are mortgages?
Yes.
Okay, bundled mortgages?
Yep.
And so what we're investing with the PIMCO, what's the color chart that we're following here?
Sure. So the multicolored lines next to the gold bars are different snapshots in time. So the most recent snapshot that we're providing here is as of 30 April. It hasn't materially changed. What you'll see, but you can go back to the end of the year, 31 December in the dark blue, 31 March, the end of the quarter in the green, and then I guess that's maroon. The maroon bar is the 30 April, consider that the current exposure. And what you'll notice is if we just focus on the government sector, you'll see relative to the benchmark, we're underneath, below exposure to government securities. That little hashtag mark above the kind of solid colored lines, that's exposure to Treasury inflation protected securities or TIPS. So we think that those offer some good value relative to government bonds that don't have inflation protection. So we're kind of mixing a little bit the government exposure because those TIPS are not included in the benchmark. But overall, we're underweight government securities. Then if you go a little bit further right to investment, it says IG, investment grade or corporate bonds. There you'll see that we are over December, March, and April, we're meaningfully underweight to those bonds relative to the benchmark. In part, that's informed by an expectation that the economy will be slowing and that those bonds may have a little bit more trouble in terms of making good on all their agreements. And then if you go to the next portion where it says high yield, that's below investment grade bonds. So corporate bonds that are lower rated, higher risk, we have very little exposure there. And then finally, if you go to the right, the very far right, you'll see agency mortgages and non-agency mortgages. For agency mortgages, those are the ones that are guaranteed by Fannie Mae and Freddie Mac, the government agencies. On a market value basis, we're about 12% overweight the benchmark, 40% versus 12%, 40% versus 28%. But from the way we look at it on a risk factor basis, we have much more of our duration coming from those mortgage-backed securities than what we would get from the benchmark. So we're overweight that sector, both on a market value basis and on a duration-weighted basis. And then finally, to the right of the agency guaranteed, you'll see non-agency mortgages. There's very, very little of these in the benchmark, but as you can see, actually for quite some time, going back from December, March, but even further back in time, that's been an area where we've been very constructive on, because these are mortgages that aren't necessarily guaranteed by the agencies, so they have more credit risk. However, the underlying dynamic for these bonds has been very positive since the financial crisis. You know, you think of the folks who have been able to stay on their mortgages and pay down their loan balances over time. They have much, much more equity than they did, say, 10 years ago. And these are the types of mortgages that we own. They offer a bit more yield than the agency guaranteed mortgages, but both segments of the mortgage market we find to be very attractive, and we think will be very resilient even in the face of an economic slowdown.
So would the non-agency mortgages, would they be more likely to be, say, commercial property than residential, or would they be a blend in the same ratio as the agency-backed?
No, these are predominantly residential. So these became, these had a very bad reputation, of course, prior to and in the global financial crisis, because these types of bonds were the ones that caused the defaults, that sort of drove the financial system to the edge. But after the financial collapse and the sort of really aggressive government re-regulation in the space, these securities now are much, much higher credit quality because the amount of equity that homeowners have in their homes is much higher than they were prior to the financial crisis. In addition to that, the ability of these borrowers to pay these mortgages is much elevated prior to what they were. So you can think of the bonds that in this bucket as residential mortgages, all with lenders who either survived the global financial crisis in terms of making good on their mortgage payments, or they had more private mortgages originated after the global financial crisis when the lending standards were so much higher than they were prior to the global financial crisis.
So private mortgages, second mortgages, is that what?
Yeah, it could be all those things. So for instance, a contractor who doesn't have W-2 income, right? It's going to be very difficult for that person to qualify for an agency guaranteed mortgage because it doesn't fit the requirements of Fannie Mae or Freddie Mac. They'll have to go to a lender and do a non-agency guaranteed mortgage, right? That's a good example of the type of folks that we're lending to.
What about, for example, if you get a mortgage that's in excess of what the bank believes the home is worth, then you have the insurance that you're obligated to pay until you work down the equity, so you have more equity than 20%. Is that it? Does that relate to whether it's an agency-backed or not agency-backed?
So those would not qualify for agency guarantee. So those would be non-agency backed. Those, truthfully, were exactly what got the financial system into problems, because even in the case, going back now, we're talking about 2007, 2008, not what we're holding right now. Folks would take out loans for more than the property was worth, in theory, put on mortgage insurance with the anticipation that that would cover lenders in the event that there was a loss, when in fact there were enough losses that the insurance providers were overwhelmed. Why we're comfortable investing in this space is that we have transparency into all the underlying loan details and borrower details, so we can assess how much equity is in the home, the type of payment behavior that has been exhibited, the debt to income ratios, all those sorts of things that we would want to have front and center. Certainly private mortgage insurance is an additional layer of protection, but it's not something that we would rely on ensuring that we get our money back, because I think a lot of folks found out in a very hard way that isn't always there when you need it, particularly if there's a broader system-wide problem. I do want to step back though, and just, though housing has been in the news, and certainly it's a more difficult environment for housing, all things being equal, we think the housing market is going to be relatively resilient as we look forward, in large measure because though prices are seeing some pressure right now, if you think about the way they've accelerated over the last several years, most homeowners have quite a bit of equity in their home and quite a bit of financial flexibility. In fact, if you have a mortgage from, say, 2 or 3 or 4 years ago, you're in a very enviable position because you've locked in rates at very, very low levels relative to what's available right now. So there's a lot of underlying resiliency in these types of loans that we find very attractive relative to other areas of the market that we think will be more volatile.
Excuse me, Matt.
Yep.
Justin is on the phone.
Okay,
You want to
great.
see if he can speak?
Yeah, Justin, you want to go ahead and give it a try?
Hi, can you hear me?
That's better. Needs to be up, though.
Yep, just speak up, but that's much better.
Okay, great. It seems as though Matt was able to walk through quite a bit of the portfolio in terms of our preferences for mortgages, both agency and non-agency. I thought it'd be helpful also to sort of speak to a question that was raised earlier about the importance of the type of style that core bonds have, particularly in the type of macroeconomic environment that we're forecasting. So importantly, when investors make an allocation to core bonds, certainly they want to have the performance associated with that allocation, but there are other reasons that I think Matt alluded to for why investors want to hold core bonds, in particular, the ability to diversify away from equities and other risk assets in investors' portfolios. So in particular, in periods of market stress, such as the financial crisis of 2008, 2009, or the first quarter of 2020 when COVID became a global phenomenon, that's the kind of environment where you really want your core fixed income to perform well, to appreciate, and really empower, from an asset allocation perspective, the ability to rebalance away from core bonds into those segments of the market that might be dislocated or where valuations might be highly attractive. If your portfolio is trading down in sympathy with risk assets, it sort of defeats the purpose of holding core bonds in the first place. So from our perspective, we're active managers. We absolutely want to generate outperformance over time. But when we think about our specific style in managing core bond portfolios, we would argue that the timing and the style of that outperformance matters. So critically, when we come to the management of portfolios, we want to be able to generate return and enhance the diversification benefits of core bonds within the context of an investor's asset allocation. I think there are a few slides that might be worth pointing out to demonstrate some of these characteristics of our style. I think the first one would be slide 31 of the presentation deck, where on the left-hand side we show what we refer to internally as a consistency chart, where the blue dots that appear above the diagonal green dash line indicate outperformance over 3-year periods relative to the fund's benchmark, the Bloomberg U.S. Aggregate Index. The net of fees over rolling 3-year periods going back to 1987, the fund outperforms 91% of the time. When you look at 5-year rolling periods, we outperform 96% of the time, and that owes a lot to the diversified approach that we use in managing the portfolio and the more cautious approach we tend to take when it comes to those segments of the market that have a tendency to absorb equity market beta in periods of market stress. And on the right-hand side, we show a risk-return framework of the total return fund, that blue diamond. We show its benchmark, the orange diamond, the U.S. Aggregate, as well as the Morningstar Core Plus and Core Peer universes, which have similar intermediate core and core plus approaches. The horizontal axis will show you the risk-adjusted return, so basically the return adjusted for the level of risk, and the vertical axis will show you the annualized total return performance. What you can see is that the total return fund has outperformed all 3 of these cohorts over the course of the past 20 years, but importantly, it does so with more efficient use of risk. So it has not only higher returns over time, but better overall risk-adjusted performance, especially when compared to the Core Plus category in Morningstar, where many times managers may be able to outperform, but oftentimes credit tends to be the mechanism through which they generate that higher return, and it comes with incrementally higher volatility. So while they can at times generate higher returns, it comes with meaningfully higher volatility. And maybe to underscore that, I think slide 32 might be helpful. What we show here is a histogram of the returns of the S&P 500 over the past 20 years. We bucket them into negative 10%, negative 10 to 5, and so forth. And in each of these buckets, we show our excess returns over a 12-month period versus the Bloomberg U.S. Aggregate Index. And we compare that to the excess returns over the same index to the Morningstar Core Plus category where the fund is classified. What you can see at the top is that the total return fund doesn't necessarily demonstrate a very clear relationship to the stock market. Whether the stock market's doing well or poorly, the portfolio tends to generate the kind of consistent performance we saw in the prior slide. When you look at the peer category, however, what you'll notice is that they tend to perform well when equities are doing well, and they tend to perform poorly when equities are performing poorly. So there's a very clear linear relationship between the return profile of many core plus category managers, such that in periods of market stress, they have a tendency to underperform pretty meaningfully, oftentimes undercutting the benefits of core bonds. The kind of environment that we think we're entering is one where central banks are, we think, stepping away from the role of volatility absorbers that they took on after the financial crisis of 2008, 2009. The past 10 to 15 years have been a period of remarkably low volatility and high returns across most asset classes. As we believe that this is ending, our expectation is that we should see greater levels of volatility across asset class, more conventional monetary and fiscal policy measures, and more differentiation across countries and segments of the market that should favor our style, which has a tendency to focus on more macro decisions and less reliance on corporate credit. I'm cognizant of the time, so maybe I'll pause there to see if there are any questions.
So when I look at the bottom of page 31, it's pretty small type, but the last footnote, since the total return fund's inception in May 87, the fund's return is 6.31 and volatility of 4.42 versus the benchmark U.S. aggregate, which might be like an index fund of bonds, 5.49. So it's almost 80 basis points more than the benchmark, but the volatility is only about 30 basis points more. So that gets to my original question that I was asking of how do you compare yourselves to other funds? So to me, that does look constructive and positive. Could I also ask, does PIMCO offer any funds that are not strictly bonds? So for example, a fairly well-known fund is the Wellington Fund, which is about 2/3 bonds, 1/3 high dividend, kind of conservative stocks. And that blend has I believe it has a higher yield over time and has appreciated a greater amount. So some investors have looked at a hybrid fund like that. Does PIMCO have any such funds?
I'll answer maybe the first question first, and then the second question about offerings. So in terms of what we do relative to peers to generate what we argue is a higher risk-adjusted performance is that we tend to have a far more diversified set of active strategies. So at any one given point in time, we will have a combination of both top-down and bottom-up decisions in the portfolio that will encompass things like duration management, yield curve approaches, other macro views such as country selection, relative value views, sector allocation, issue selection, instrument selection, and currency. At any one given point in time, we will have dozens of active views deployed in the portfolio. We will ensure that no one active view dominates the risk profile of the portfolio because we think that lends itself more to better consistency. If we're concentrating risk, that tends to reduce the overall efficiency of the portfolio and diminish its Sharpe ratio. So diversification is a key part of our style. We also embrace a global opportunity set. So we will invest in markets to some extent outside the U.S., particularly developed market, interrate markets such as those in Japan, the UK, Eurozone, where we can be long or short those markets. But the key is to have a very deep toolkit where we have an edge, we think, in all the various markets we invest in, and not letting any one particular active view dominate the risk profile. And over time, that we think is able to deliver the kind of consistent alpha and the improved results relative to peers where credit tends to be the preference over time. in terms of our offerings, we do have a wide array of offerings that span the fixed income markets, short-term markets, asset allocation, and all things in between. So certainly we do have offerings that will invest across asset classes in our asset allocation platform. But I don't know if Matt, that might be a question best suited for you.
Yeah, no, I would say, I would echo that. The short answer is yes, we do. One strategy that I would highlight in particular is the PIMCO Income Fund. It has a more of a yield orientation that you were describing, similar to the Wellington Fund.
I want to correct myself. Actually, I said Wellington, but it's actually the Wellesley Fund that's two-thirds.
Okay.
It's actually the Wellesley Fund that's about two-thirds bonds and one-third stocks.
Got it. So this particular strategy doesn't necessarily lean into a third of a stock market exposure, but in a similar vein, it has more of an higher income orientation. The only thing I would observe there is that we're very cognizant of the benchmark that you all selected in terms of your asset allocation. So using strategies like that will bring in more equity-like risk, more potential equity-like volatility. It can be very helpful when things are going well, but you also have to be prepared for those times where that additional equity risk and volatility can create greater downside effects. As an example, this fund would do better in an environment relative to, say, either one of the strategies we were just touching on, where the economy slowed materially and the stock market was down materially because of that economic slowing. We would expect this fund to outperform those more income-oriented funds. On the flip side, if the economy is doing really well, you'd expect stocks certainly to outperform bonds. And in that context, that type of environment, you expect those more income-oriented strategies to outperform this strategy. But we're part of a bigger picture, so we'd want to be sensitive to how you wanted to balance all those considerations.
Got it. But also, for example, in the recent unusual circumstance we had where both the stocks were going down and the bonds were going down because interest rates were being raised very quickly, and so people were devaluing their existing bonds.
Yes.
In that experience that we just went through, which may not happen again for another 10 years or 20 years, who knows, but it could happen again, in that environment, actually high dividend yielding stocks did not suffer very much. They were among the best performing of the stock market, and they outperformed bonds.
Yeah, and higher income oriented bonds did particularly well relative to what I would say traditional bonds. So as an example, what's a example of a higher income oriented bond? There's a category called bank loans, which offer usually higher levels of income, but they're also based on floating rate debt. They actually had a relatively good year last year when the rest of the bond market was challenged. But they're also lower credit quality, so there's more risk that those types of bonds may default. So there's definitely environments where lower credit quality, from that perspective, higher risk bonds can outperform, say, treasuries or mortgages or those sorts of things. Conversely, there's certainly environments where, and again, I keep coming back to sort of an economic slowdown, where you'd expect those segments of the bond market that have a little bit more equity flavor to them to underperform more traditional bond market segments. So there's always going to be a trade-off there.
So to summarize, it sounds like because we've asked for a bond portfolio in this genre, that's why this particular PIMCO fund was selected.
We think this is yes.
But PIMCO, which according to Morningstar is highly rated as a company, so you're among the best companies out there in bonds according to Morningstar. But you are saying that you do offer, if an investor wanted to, whether it was a pension fund, an individual, or an endowment, that any of those investors could look to PIMCO for a different kind of fund that would have a higher yielding, expected higher yielding, a blended fund that might have some high dividend stocks in the portfolio.
Yes. Now, we do funds that mix between stocks and bonds. The income fund is probably the closest approximation to that sort of mixing high dividend stocks, although the income fund now, while it has the authority to do that, doesn't invest in high dividend paying stocks. It uses other areas of the bond market that would approximate that type of exposure to get similar results along the lines, but staying within the confines of fixed income. But the short answer is we manage strategies across the entire capital market spectrum, including these blended approaches that could target higher levels of return and higher levels of yield if that's consistent with what your objectives are in terms of your fixed income allocation.
Thank you.
Okay, I peeked at the clock right before we started, and according to my math, which you may be dodgy, we're about to find out, I think we have 9 minutes left. So if we've answered your questions and provided the information you need, we're happy to wrap up. We can go for the next 9 minutes. It's really, Mr. Chair, what would you prefer?
Not knowing what you'd give us in that 9 minutes, it's hard to make that decision. It might be the golden nugget.
Well, I guess, look, I think it's incumbent on me to just highlight that, it had, relative to our benchmark, this year has been good, but we've had performance challenges. So if you jump ahead all the way to page 35, you'll see that we have the year-to-date performance through the end of May. We're just outperforming the benchmark by about 0.1%, so 10 basis points, 2.6% versus 2.5%. If we were actually to update that chart through yesterday's close, the return of the fund is 2.61%, so basically unchanged since the end of May. The benchmark has actually lost a little bit of value, so its year-to-date return through yesterday was 2.4%. So we're outperforming by about 0.2%, 20 basis points. But there's points in time where we will have performance challenges, and we have had some performance challenges. Last year, we underperformed the broad benchmark. But as you go further back in time, we've consistently, as Justin highlighted, on rolling basis, has been able to deliver good returns on behalf of our investors. So we underperformed in 2022. We're on our way to recapturing that performance this year. We're off to a good start. But I feel that it'd be disingenuous to you all to sort of present a picture where we're successful all the time. We have ups and downs just like everyone else. And last year was a bit of a down year, not only for the bond market, but for us. I think I'd underline what Justin said, though, is that the environment that we're getting into right now is going to be, we think, significantly different than the environment that we've been in the last 5 or 10 years, where central banks have been trying their best to remove volatility from markets. If anything, central banks have been an agent of drama and volatility in marketplaces. Certainly we saw that last year. And perhaps counterintuitively, that's exactly an environment where we think a firm like PIMCO that has global resources and deep capabilities across all segments of the capital markets, but particularly in bonds, is so well equipped to deliver for you and your participants by going out and scouring the global capital markets, the global bond market, to find those bonds that will deliver the best risk-adjusted returns going forward. I'd sum it up by saying that you're invested in a high-quality bond portfolio right now that yields just over 5.3%. We're very enthusiastic about the prospects for fixed income going forward. Yes, last year was painful, but the opportunity set right now we think is very exciting. And we are very excited to deliver that high-quality bond portfolio to meet your portfolio needs. And to the degree that you want to evolve your allocation, we're happy to engage in discussions with you and with Callan and whomever else you would like to make sure that we're presenting and providing the solutions that you need to meet the return objectives that you're managing for your beneficiaries. I think that's probably all that's worth saying, but I'm happy to stick around. There's harder places to visit than Ukiah, California, that's for sure.
Right. Any other questions from board members?
Well, I'll ask, did you look at the memo I wrote a few months ago?
I have heard about it. I confess I have not had a chance to review it, but I'd be happy to.
So I'd like you to see it because I used Portfolio Visualizer, which is one of the tools out there to look at past performance. Can't tell you about future performance, can tell you about past. And it subtracts out management fees. And so I plugged in our 2 bond funds, which PIMCO being one of the 2.
Yep.
And I compared if we had half of our bond portfolio in the 2 existing bond portfolios, and half of our bond portfolio in the hybrid fund, the Wellesley fund, we would have only introduced slightly bigger drawdowns in the down markets that were experienced during those 29 years, but we would have outperformed over those 29 years the two strictly bond funds. And so I completely get the principal reason why we have money in bonds is for stability in the total fund, because we're writing checks every month.
Right, right.
It's not like an investment
Right.
that any of us might have for a future retirement out
Right.
there, and we're not too concerned with the ups and downs of today's market if retirement's somewhere out in the future. But for
Right.
this institution, we want stability in the fund because every month those checks are going out. But nevertheless, we're also interested in long-term performance and relatively predictable performance. And so again, I think it's interesting that when we look at the last 29 years, we would have only introduced a little extra only slightly bigger drawdowns if half of our bond fund had been in the hybrid fund by Wellesley.
Right.
And that's why I'm asking if your company has its version
Yes.
of the Wellesley fund,
Yep.
where we could put, because I'm posing the question, why don't we take some very slight additional risk in our
Sure.
bond portfolio, but get more return out of it? So not to put all of our bonds in, or bond portfolio into a slightly more volatile, higher yield return, but why not put some of our bond funds into that?
Yep. No, I think it's a very appropriate question to ask and a very good one, and it's exactly the type of portfolio questions we love to explore with clients. We actually have a solutions and analytics team dedicated to really analyzing these types of portfolio construction questions. We'd be happy to look at that, and we'll work with Robert to get a copy of the memo. And then the PIMCO Income Fund is probably the closest analog to the fund that you described, but would be happy to kind of propose some thoughts around, if you were to modify your bond exposure in, say, one or two different ways, how that would affect drawdown characteristics and yield and income characteristics. I think all those things are always worth asking when you're thinking about your bond allocation. So very much appreciate the invitation to do that analysis with you, and look forward to sharing with you the outcome of our work.
Okay, great. Well, thank you so much for your session with us and giving us a better understanding of what you are doing for us.
Well, thank you folks again. Really appreciate the time today, and always happy to return to visit. I think I was last here probably about 10 years ago. So hopefully it won't be 10 years for the next iteration, because I'm not so sure I'll be hanging around at PIMCO for the next 10 years. Who knows, right? I guess none of us know where we'll be over the next 10 years, but really appreciate your time.
Thank you.
Thank you.
And with that, we'll take a 10-minute break.
Thank you so much.
Be back.
camera, Ryan?
Sure. And of course, everything went off my screen. Yeah, so I gotta get back on.
I still have a blue screen, Ryan?
We got that cute, that nice logo up there.
The meeting's not coming back up, the Zoom?
All right.
No, we have an active Zoom meeting. That's because this is a webinar. So I've just got the blue screen with the symbol.
You ready? Oh, okay. Sounds
I
good.
thought that you did this on your end.
Yeah, we're still technically
My panelists are in.
they're still
Oh.
teching around over here.
I'm not sharing screen. I thought that was normally in the
Oh
control booth.
boy. Yeah, well, both Jerry and I have some hearing issues, as does Doris.
This is,
And so that stuff was like, holy shit. Yeah, yeah, right. You know, it's funny is,
you want me to restart?
right, well, like I turned on my screen here to do the Zoom, had to turn it off because that wasn't working.
I mean, it was working fine until we took a break.
Yeah, right.
And I didn't
right.
do anything. I think you just.
Yeah, I saw you doing, I saw you
I'll find
doing
it.
that, and then I finally went, oh, well,
Hmm.
So,
yeah.
Is the camera
yeah.
still off? I mean, isn't that what that's indicating, or?
I mean, I don't actually control I just pick the cameras that
Okay,
displayed.
I see. Let's go back to, can you click on the panelist there? Yeah, see my camera's on, we're not muted.
Oh, really? Wait, well, you know, it's interesting is I just remember years ago doing a Dodge and Cox versus PIMCO comparison
strange.
here. And if you look at the returns from Dodge and Cox, they're significantly higher. And, why is it? What's the composition of what they're doing? And then reviewing that whole philosophy of, okay, we're at PIMCO for Y, and we're at Dodge and Cox for Y, et cetera, et cetera.
I assume that's not what you're wanting. Output.
Uh-huh,
That's really strange.
got it.
Yeah. I, okay, because usually we end up seeing something on the screen. We really don't have any participants who are on
So
video.
are we
So
on
maybe that's
audio
why.
on the screen?
So, I think we'll just
Okay, this
proceed.
is just a
'cause they've been able
localized
to
camera.
join and participate in the
You want
meeting.
this on?
No, that's okay. We're going to go ahead and proceed. We have no panelists on video for this meeting, so I believe that's why we're seeing the blue screen. But the public can see us. Correct. Right, because we're in this room attending the webinar, we're going to get the blue screen because we don't have a panelist on camera. I think we can proceed.
All right. That was the longest 10-minute break in history. So we'll now go to our item 4B, which are our monthly investment performance report. Robert, take it away.
Trustees, you have before you the monthly investment report. I'd be happy to answer any questions. The one thing I guess I would note, we pulled some money, and that is the last bit of money that we're going to be pulling for benefit payments. The total came in about $8.8 million. So for the year. So that was good. Yeah. So that was nice. Less than 10 is good. We like that.
Anybody have any questions about this report? Okay, well, do we need a motion to accept the report? Nope. Okay, very good. Well, thank you, Robert. And our next item is...
We should ask for public comment on
Oh.
item 4, if I may.
Excuse me. Is there anybody in the public would like to comment on the investment performance report?
There is no public comment.
All right, thank you. So our next item is item 5, which is discussion of possible action regarding the draft separate account community property division policy. I
Thank you,
imagine Ms.
Chair
Doris.
Shoemaker. In response to the adoption of Serial Article 8.4 permitting separate account administration for Mendocino County by the Board of Supervisors in May, I prepared a policy that outlines the provisions and how we would implement it. It includes scenarios to help folks understand the impact to both the member and non-member account in the event a separate account division is done. I'm happy to answer any questions you have regarding the policy or implementation of the split accounts.
Jerry, go ahead.
I'd like to move staff recommendation.
Is there a second?
Second.
Okay, any further discussion by trustees?
Yeah, I had one question, and I'm not sure if it might actually be answered in here. If somebody has who is not a member, is granted an account, would they be able to have reciprocity using that account with another organization?
No.
No? Okay.
This is tied to the member in the development of that service credit. So while they do get a separate account established that dollars of contributions and interest would be transferred into and years of service credit granted to them, they had no employment relationship to establish reciprocity through. I also would like to point out that council notified me of a couple of typos in the model DRO that is also attached as a supplement to the policy here, and that has been corrected for our version for members.
Any other questions? Any comment or questions from the public?
There is no public comment.
Okay, could I get a roll call vote, please?
Yes. Mr. Land?
Aye.
Mr. Jurdy?
Yes?
Ms. Cavanis? Aye. Ms. Harris? Aye. Mr. Shoemaker?
Aye.
Ms. Cubison?
Aye.
Approved.
Okay, that brings us to item 6, which is agreement with Hanson and Bridget LLP for legal services for fiscal year 2023-24. Doris?
Thank you, Chair Shoemaker. Sarah has had a contract with tax counsel for the past several years. This contract would just extend it for the coming fiscal year. We want to maintain a contract with Hanson Bridget because they have been intimately involved with our voluntary correction application with the IRS and our power of attorney to contact the IRS regarding those application. So this is just to extend the contract for 1 year.
Okay. Trustee questions? Jerry?
My apologies, I just forgot to put it in there. Staff recommends that you extend the contract with Hanson Bridget for fiscal year 23-24.
Jerry? Second. Thank you very much. Any trustee questions or comments? Public comments or questions?
There is no public comment.
Roll call, please.
Mr. Land?
Aye.
Mr. Jurdy?
Yes?
Ms. Cavanis?
Aye.
Ms. Harris?
Aye.
Mr. Shoemaker?
Aye.
Ms. Covison?
Aye.
Thank you.
Okay, and that brings us to our HBRP project report discussion.
Thank you, Chair Shoemaker. Attached is a summary report of the activity on the Historical Benefit Review Project through June. If you have any questions regarding this, I'd be happy to answer any questions. This is a slightly different format, but it provides the same summary information as the prior version.
Okay. Trustees? Seeing no one interested in anything on this? Public? Okay. Thank you for the report. Moving quickly down the line is our item 8, discussion regarding the administrative report.
Thank you, Chair Shoemaker. In the administrative report, I wanted to mention that we are in the process of testing a release update to Pension Gold that involves numerous modifications to the general ledger process for the transfer of reserves when someone retires, among other things. And we have another release queued up and ready to go that will take care of some updates to the actuarial valuation extract. So there is a lot of activity there. Once we've wrapped up those two major sort of releases, I'll discuss with Pension Gold vendor Leve Ray Shroop when they may be able to look at scheduling the work necessary to implement the separate account division that was just adopted by the Board of Supervisors. So there will be a slight delay before we can actually divide someone's account because we don't have the software updated to permit for that, but we will start accepting a domestic relations order that use the new separate account language. It may just take us a little bit to get those actually split within our software. I did give a presentation to a labor group at the request of the county and the MCPEA back on June 2nd. I have another one for the MCPAA group on June 22nd about the status of the system. We have a couple seminars coming up for members. We're wanted to point out some upcoming educational opportunities and also note that there is a SACRS legislative update attached to the report. I'm happy to answer any questions if you have any.
Any questions? Jerry?
I couldn't open or I didn't see the legislative report. But I couldn't open it on my at home.
It is attached as a separate agenda item subject to, I can show you where it is if you need, but we do have it available.
I just wanted to be sure that I didn't miss something.
It was item 8B on the website, if you open it from the website. Ms. Cavanis, do you have a question?
Okay. Okay, I didn't do that, and I couldn't open a word.
Okay, any other questions on the administrative report, accompanying document? Public comments to it?
There is no public comment.
Okay. That brings us to general board member discussion. Comments by any trustees? Jerry?
I'm just taking up all this time. I went to the SACRS conference in San Diego. Sorry, guys. And it was excellent. Beautiful venue, interesting people. I felt there were a number of sessions that were extremely useful. Andy was there. There were people who asked about Doris. Was she going to be there? So we have a bit of a reputation, a good one, and it was my pleasure to be able to participate. So, thank you.
Kathy, anything? Catherine?
What?
Anything to?
I just wanted to say thank you to Jerry for going and for reporting on it. Yeah, really good.
Any other comments?
Yes, I'd just like to say thanks to everyone for welcoming me onto the board. It's been fun so far, a lot to learn. And also, I will not be here for the next meeting in July. I will be traveling. Made travel plans before I knew this position was going to become available. So thank you.
No, we just might have a committee to put you on while you're gone.
All right.
How about audit?
Oh, boy, the audit committee. All right. I will say, I'm sorry to hear this, but Kathy Smith has resigned from the board. And I just out loud want to say I've really appreciated working with Kathy at this board. She's a, solid administrator, a solid board member, and last year did an extreme amount of work working with Jim and I in regard to the evaluation policies and processes. And so anyway, I think she'll be missed significantly. So anyway, thank you, Kathy, very much. Hopefully there's some award, plaque, whatever we can do for her. And thank you. One comment I have, and I don't know if I've ever brought this up before, but when I sit down at one of these and I'm flipping through, looking at the agenda, opening the item, and a lot of times I'll try to set everything up in a row, and if I get off base, if the item number were actually in the corner of the lead page of every item, it would make that so much easier. And that's like, so if you open something, you go, oh, I'm on the right item.
I think we can add that certainly to all of the materials that MSARA creates. In certain instances where we're getting PDFs from the investment consultant, the auditors, the actuary, et cetera, we wouldn't have the capacity to.
And a little felt pen. Right on
We
the
deal with everything electronically. We don't have an opportunity to
Yeah.
have a print one to write that on. But I do understand, and we'll see what we can do about adding that even to materials submitted from others. But sometimes they come protected and we can't.
Sure.
I may be able to add a custom stamp.
Yeah, that would be nice and helpful. And it really comes out that twice I've done this job, I'm going, oh my God, I wish this was labeled. All right, so that would bring us to our closed session. Yes.
For the chair, since you're going to go into closed session, is it okay if I return to the office, or would you like me to stay here for your report back out of closed session?
No, you can return to the office.
Thank you.
That's great. So we'll go into closed session for two items, public performance employee and performance evaluation of the executive director. And the second one is a conference with labor negotiator in regard to the executive director. Thank you. Do we have to ask for a motion to adjourn? We're adjourned. Oh, we're not adjourned. We're going into closed session. We'll adjourn after the closed session, after we report out. Yeah. Dan, are we going to the conference room?
Report out from closed session. The board met on items 10A and 10B. On 10A, public employee performance evaluation for the executive director, the board met in closed session and discussed the evaluation. Has not been completed yet. On item 10B, the acting chair appointed Jim Anderson to be on the labor negotiator committee. That's it.
Are we adjourned?
Meeting adjourned.